Good morning, everybody, and thank you very much to each one of you in joining us on a Sunday morning. With markets at all-time high and most states in India opening up the unlocking process and a series of events and activities that's driving economic growth around the world, investors today have a lot on their mind in terms of how do we approach this ever-evolving landscape. With this background, we thought that we should share our perspective with you. And we have Nimesh Shah, Managing Director of ICICI Prudential Mutual Fund, and Naren Shankaran, Executive Director and Chief Investment Officer of ICICI Prudential Mutual Fund, to share their thoughts with you. Once Nimesh and Naren finish sharing their thoughts, we will have an interactive question answer session. A lot of you have sent us a lot of questions. And if there are any further questions, please use the chat box to send in your questions. So without any further ado, I would like to invite Nimesh to share his thoughts with us. Thank you again.
Excellent to talk to our esteemed customers on a Sunday morning. This is a sign that the markets are really doing well. If Sunday morning, this is the kind of inflows that we are getting of the customers who want to listen to us, so it also adds a tremendous responsibility for us as a company. I always say that I feel that I am the CEO of ICICI Prudential Risk Management Company. We always call it because in our minds, risk management company, when you are managing 4,50,000 crores of common man's money, it is more of how do you manage your risk. In business, it is very important to know what you don't do, right? What you should not be doing when you're managing somebody else's money. It is not that it is our money where we can take as much risk as we want at that point of time. It is people's money where we have and I believe that if things go wrong, then ultimately the brand has been blamed, right? So I look at this business as that I'm custodian of the brand in this business. ICICI Prudential is a very, very important brand. People come into this business, invest over here because they believe and trust the brand. So my job in this company is clearly custodian of the brand. And by custodian of the brand, I think the most important thing is control risk and how do we manage risk. Because if you want to generate return, there is no choice but to take risk, right? If you don't take risk, you don't get return. So risk has to be taken. How do you measure risk and how do you control it that it works in the customer's interest? That is our job. So it is very, very important that people also understand the concept of risk-adjusted return, which we continuously measure. Whenever you look at return, whenever we look at return, whenever we measure our fund managers for return, we also continuously measure the risk that they take and generating that return for you. And that is extremely important. When you enter our company in BKC, right, when the gate opens, on the main door itself, what is written is SLR. Safety, liquidity, and that return. And return is the last. The first two things are extremely important. So safety, liquidity, and then return in that order. That's how we look at the business. People want first safety and liquidity. That is very clearly exemplified by the amount of bank deposits in the country. In this country, there is more than 150 lakh crores of bank deposits, right? Mutual funds is only 30 lakh crores. But what happens as a country develops? As a country develops, the depositor, as we move from a 3 trillion economy to a 5 trillion economy, the depositor will become an investor, right? It has happened in every country in the world. That two things happen when a country moves from $3 trillion. As we move to, in the next 4 or 5 years, we move towards a $5 trillion economy. As we move towards that kind of economy, you will see that more and more depositor will become investors. We have been seeing it in the last 6 months, and it will happen going forward also. And another thing that happens that the total market cap in the country, or the total value of the stock market, let's not use jargon, the total value of the stock market will keep on increasing, right? As the economy grows in size. So in that also, we have to see how can our customers participate in the growth of India as well as we control risk for them. See, it's not going to be a straight journey. We believe that India, emerging market, which is based on flows that come from the Western markets also, it will not be a straight line increase. There will be increase, there will be drop, there will be increase that you can see over the next 3 years. And we believe that volatility is going to increase in this markets. right? Volatility is going to increase, while Naren will talk about lots of opportunities that are possible, that can happen, as well as we need to be cautious that how do we go through this volatility and what are the customers' expectations from us? How do we meet those expectations? So a lot of customer behavior we have seen over the last so many years. And we feel that one of the biggest issue is that the customer is expecting that he will consistently get return in a volatile market. That is very difficult. That is very difficult. It is not possible. If the markets go down, my equity funds will go down with that. We are not magicians or we are not hedge fund managers where we are promising you absolute returns. A mutual fund goes with the market. What is the endeavor of a mutual fund? Endeavor of a mutual fund is that if the market grows X percentage, can we grow more than that? By market, I mean the Sensex or the Nifty as we call it. If the benchmark indices grow by 10%, can we beat those indices? And that is why you invest in mutual fund. Mutual fund does not give absolute return. That's why we call mutual fund gives relative return, that we are supposed to give something more than what the markets give. So essentially, there are two ways of making money. One, you are so smart that at any point of time, you grow more than what the markets grow, right? And there is another strategy which one follows, that you also, or either you try to grow more than the market, or you try to fall less than the market falls. If there are equal number of days when the market grows or the market falls, it might be a better risk adjusted strategy that as a company we follow, that you fall lesser than the market. Over a period of time, if you fall lesser than the market, then over a period of time, then you will see that you are able to give a good risk-adjusted performance to the customers. So how do we protect our brand and protect your investments in a volatile market when you want a relatively customer's expectation is consistency? So we have realized another thing also, that is the question in front of us. And another thing that we have realized, that customers tend to give more and more money when the markets are higher and higher. As the markets go higher and higher, customers tend to give more and more money. That is track record of last 22 years in India, as well as if you see outside the country also, the same track record continues, right? People do invest in the markets more. Normally, people want to buy everything cheap. Whenever things are cheap, we go and buy them. We go and buy products in a sale. But equities, we tend to buy. As a country, we tend to buy when the equities are expensive, more retail customers come into the market. So how do we protect that retail customer? So we have realized that through a product strategy, because customers will always give us more money when the markets are high. So when the money comes in, we have created a set of products. ICICI Prudential is known for creating a set of products whereby we will take the money when it comes, but will not deploy the entire money into equities at that point of time. We created a strategy called Balance Advantage Fund. Sometime in 2012, 2013, we came up with the strategy of Balance Advantage Fund. And now it has become, we came up with a fund. Now, over a period of time, SEBI has created a category called Balance Advantage Fund because they saw what we are doing. What are we essentially doing in it? That at all-time high, if the customer gives the money, we take the money, but we don't invest the entire money into the equity markets. So if you give me today money in ICICI Prudential Balance Advantage Fund, approximately 39% is invested into the markets, into the equity markets, and the rest goes in arbitrage funds or it goes into debt funds, which would give relatively stable return than equities. Why is that happening? Suppose you would have given us money in April 2020 when the market had fallen down to 30,000 or less than 30,000. At that time, the equity weightage in this fund was 75% or more than that, right? So when the markets were low, we invested more than 75% into equities. And when the markets are high today, we have invested only 39%. So what did we do? We sold. As the market was going up, you keep on selling and you keep on buying when the markets are down, right? So if the markets keep on going up, we'll keep on selling. And if the markets keep going down, we'll keep on buying. So that traditional thing that customers should be doing, what do customers do? They give us more money when the markets are at the top. And what do? That we take the money, but we don't invest it fully in equity. We wait when the markets react, and when the markets fall, we'll keep on buying. So whenever everybody else in the market is selling, we are buying. And whenever everybody else is buying, we are selling. So that particular strategy has given fantastic experience to the customers over a period of time. So I think one of the biggest things that we have been able to do as a brand is to protect the customer in a growing market. Maybe if suddenly the market goes up, you may not get the full return that the market is giving,
But suddenly if the market falls, definitely you are protected from the downside. To a great extent, it has given the customers a good experience over a period of time. Now it is 8 years since we are running this particular strategy, and it has been very stable and it has given a good customer experience. And we are very happy and satisfied about that. Another thing that the Indian customer always looks at, and we see a very pattern to that 1 year performance of any fund goes up, the people start investing in that fund big time. I just want to explain one particular thing which is very important to my mind, is that if you invest, don't look at only last 1 year return. Please look at a long track record of performance and then come into funds. Minimum that you look at equity. Whenever you come into equity, the minimum time you should give us to perform should be 5 years, right? It cannot happen that if you invest tomorrow, every 14th day, if you go and see the NAV, markets don't work that way. A good fund manager cannot be consistent. A good fund manager will take a call before the market is taking the call. Before everybody else buys that stock, he needs to buy that stock early, so that when everybody else comes to buy that stock, the stock will go up, right? He needs to do that. So sometimes you buy and the others start, you see the value in the company today, you buy it today, the rest of the market will see the value in that company 6 months down the line, 1 year down the line. So 1 year after you have invested, also it can do well. So please don't track 1 year performance. Minimum track is what one should track is 5 year performance, because there are cycles. Look at our fund, ICICI Prudential Discovery Fund. If you would have seen it 1 year back, you would have said, no, this fund is not doing well, I'll not invest in this fund, right? Because short-term record was not good, right? 1 year track record was not good. But if you see the long-term track record, it has got a 10-year history, more than 10 years history. So if you look at it, it's a value investing. Value stocks were not doing well between 2018 to 20. So that fund did not do well. But now value stocks, since October 20, markets have broad base, and Naren will talk more about it. The more and more stocks have come into the value has started working. So once the value stocks have started working, the broader markets have started working, that fund is at the top and it has given fantastic returns over the last 6 months, 1 year. So please do not look at fundamentally the fund house, how the fund house has been behaving over a period of time. What is the quality of the fund house? Is it been able to attract the best people and attract into that? And then you can get invested in that fund house. Another category that we have introduced in this market is called asset and fund of fund. I think it is a very, very important category and customers should know. What is a mutual fund? Mutual fund goes and buys equity. When you equity mutual fund will go and buy equity when you want it. What does a fund of fund do? A fund of fund goes and invest in the various funds that ICICI Prudential would have, right? So it will go and invest in other mutual funds. So it is a very good strategy. It is very well managed by SEBI, controlled by SEBI in terms of expenses. So that expenses to the customers are the same, whether he invests in a mutual fund or he invests in a fund of fund. So there is a huge advantage. We had come with a fund called as asset allocation fund. So asset allocation fund, as the name suggests, it allocates to gold, it allocates to equity, it allocates to debt based on the market valuation. While balance advantage fund will only invest in equity and debt, direct stocks into equity and debt. A fund of fund will invest in mutual funds, so it can invest also in our gold ETF, right? So we have created all this defensive fund, whether it is a fund or fund of fund. Fund of fund also helps us in designing products better. So the entire customer behavior, let it be pro-cyclical, right? Or pro-cyclical means let the customer invest with us at whatever time. We want to create an AMC where the retired school teacher of Guwahati, that is because I have got customers right from Guwahati to Kottayam to Gujarat to Kashmir to Kanyakumari. So I have to take care of the entire. So always we say that the retired school teacher of Kottayam or retired school teacher in Guwahati is my customer, and I should plan my products as per that. So we have created a set of defensive products, and our endeavor is that we lose the minimum, right? If we lose the minimum, we'll do well for the customers over a period of time. So we have also come with another NFO right now, which is called ICICI Prudential Flexi Fund. Right? It is a very good diversified strategy where Naren will talk more about it, and I'll ask Naren to talk about it more. Naren, you can come.
Welcome to all of you. It's a pleasure talking to you on a Sunday morning. The last time we spoke on Sunday morning was in 2014. At that time, what had happened was, there was too much interest in physical assets, and people were not interested in financial assets. So, we had to jago people and tell them, don't keep investing in physical assets like real estate, move to financial assets. So how best to do it? We said that we have to do events on Sunday morning. So we used to do events on Sunday morning and talk to all mutual fund distributors and tell them, get people into financial assets. The time for physical assets is over. And at that point of time till today, it has been a absolutely phenomenal journey for financial assets against physical assets, that it is something that we have felt very happy about. So on this day, on Sunday, it is slightly different because financial assets have outperformed physical assets drastically. So if you look at the last 7 years, between 2014 and 2021, anyone who was in financial assets has done very, very well. Whereas if you look at an asset class like real estate, the asset class has underperformed equities drastically. So when we again do an event on a Sunday, the kind of thought process that we have to do is different. I have a guru called Michael Mobesin. He says that never do something as a post-mortem. Always do something called as a pre-mortem. What is a pre-mortem is you look at what has happened over a period of time, think what has happened, and have a discussion when things are very good and ask yourself, what should you be doing? So today, if you look at it, all the financial assets have done well. If you have invested in any debt mutual fund over the last 3-5 years, you've had very good returns. If you have invested in most equity mutual funds over the last 3 to 5 years, you have had very good returns. So what does pre-mortem suggest? Pre-mortem is a discussion after things have gone well. So we asked ourselves, which were equivalent times like this? So we looked at 1999, we looked at 2007, and we looked at 2017. These were 3 times when everybody was happy. And we said, what should people have done there at that point of time? So we realized at that point of time, what mistakes did people commit in 1999? The mistakes that people committed in 1999 was focus on technology stocks alone and invest in technology fund. They did not believe in asset allocation. They did not believe in investing in diversified equity funds. They did not believe in investing in debt funds. In 2007, when market was high, what mistakes did people do? They invested in infrastructure fund. What mistakes did they not? What could they have done? They could have invested in diversified equity fund. They could have invested in debt fund. They could have invested in asset allocation. In 2017, they could have invested in diversified equity fund. So what did it mean today for us? As Nimish correctly said, one of the most important things to do today at this point of time is to do asset allocation. And that is number 1. Number 2 is that the debt mutual funds have delivered very good returns. So we are grappling with the situation that when we do an analysis of the past, when interest rates come down, all the debt mutual funds deliver very good returns. But when interest rates go up, they don't give as good returns as they do when interest rates come down. So what do we do at that point of time? This is the challenge that we have when we communicate to investors. Because when interest rates come down, they give very good returns. Look at all the returns that have been shown by debt mutual funds across the space. You will find that the returns are very good. So we said, what does it suggest today? We can look at a category like floating interest. What does a floating interest category do? As interest rate goes up, the floating interest also goes up. So that is a category where interest rate goes up, the floating interest also goes up. So that is one interesting area. Then you look at arbitrage. What does a category like arbitrage do? It buys equity and sells futures. So that is primarily what it does. So that is a much lower risk product when interest rates go up. The SEBI riskometer also says that. So that is an interesting category. Clearly, if you look at equity saving as a category, that also by and large has a very big allocation to arbitrage, a small allocation to equity. So we said our analysis at this point of time says when interest rates are going to go up over the next 2 to 3 years, these are interesting categories for people to think about. So asset allocation is one. Debt, mutual funds across the board are not going to give you returns like what they gave you in the last 3 years. That is the second. So the third, which came out very clearly on our discussion on all-time highs, was that you have to have a product which is widely diversified. So what is that category? Nothing better than a FlexiCap NFO. SEBI gave us this permission to launch us a FlexiCap NFO, and we said that the best time to time it is when markets are at all-time high. What does the scheme information document say? The scheme information document says we can invest in large cap or mid cap or small cap. And it needs to be invested up to 65%. And the advantages, there are a lot of possibilities to use derivatives as an hedging tool as per the scheme information document. Again, I go back to my guru, Michael Movison. He always says, use quantitative backtesting tools. They will lead to mistakes, but they are less error prone than human beings. So when we tried to popularize balanced advantage fund, we used to use a price to book model to popularize it at that point of time. Because what we realized was the price to earnings did not work. And we tried it in 2008, it did not work. So we started using price to book. And back testing means we use a set of quantitative models. We use some numbers to see what works. So in this case, what we did, we used a set of models to decide how to allocate money between large, mid, and small. And then try to look at whether that can work. What does the model suggest? It says that in 2017, you should sell mid and small cap stocks from the portfolio. In 2013, it says that you have to buy mid and small cap stocks in the portfolio. In 2013, small and mid cap was cheap. In 2006, small and mid cap was costly. In 2008, small and mid cap was again, cheap after lemon. So we tried doing all this backtesting. Is it something which is error free? Certainly not. There are mistakes that fund managers can commit. There are mistakes that some of these models can also commit. But the advantage is, at least it is emotion free. And we trying to use this in our FlexiCap model. So the advantage with launching a FlexiCap model is that we are using a model which can actually try to deliver emotion-free way of investing in large, mid, and small. Because what is the advantage of mid and small cap stocks? In the very long run, they deliver very good returns. But in the short run, they are much more volatile than large cap. And that is the reality of equity also. In the equity, they deliver very good returns. In the 17 years that I've worked in ICICI mutual fund in equities, they have delivered very good returns. But in between, in 2008 or in 2011 or in March 2020, they delivered very bad returns. So the advantage with using these models is it reduces the emotional problems, and we hope that they will work. So what all the work that we have done says that when the markets are high, you should have a flexible fund which can invest in large, mid, and small. And that is what we're trying to do by launching this fund. What are the risks in the market? When we look at the Indian business cycle, we find that the risks are very low. Why? Because the credit growth is very low. In 2007, credit growth was very high. The corporate profit to GDP, that is an indicator of how elevated profits are, is very low. Everything as far as the Indian business cycle is concerned is very low. On the other hand, if you look at US, everything is very high. And we are always worried one day due to US markets will fall in India. Can we predict it? Answer is no. So one of the biggest tasks that we will have in this fund would be how to navigate the next few years in terms of handling the US risk. And that is the biggest challenge that we will have, which we'll take up, and we hope we get it right, because always there are challenges in investing. Like, you know, when we launched the Value 19 fund in January 2018, that was the time when Nimish returned small cap money in PMS. We took the challenge and said we will raise money in mutual fund, because it's not a small cap fund that we launched in Value 19. So we said we'll raise the money, and it was a closed-end fund. So, you know, we knew that money can be raised and invested across. So the fund used to go up, then go down, go up, go down. But because it was a closed-end fund, the advantage was people couldn't take out the money when the fund did badly. But luckily, when the fund ended last week, we could deliver 14 rupees 45 paisa only because towards the end the fund did well, and because the markets always are volatile. And if you are able to maintain a process, in the long run, they deliver returns. In the medium, they actually create problems. So that is the advantage again of launching something which is flexible. In Value 19, if you had looked at somewhere in between, there would have been problems, because at the end of the day, but the fund was flexible. It had the potential to do many things. Like that, in Flexi Cap, we have the potential to do many things. Of course, there are always challenges which are going to be there in the next 2 to 3 years. That is how we see it. So overall, all our discussions at this point of time, when the markets are where we are today, say that you have to do asset allocation. Even if interest rates are low and you're getting very low returns in other debt products also, you have to do asset allocation. The second, you have to be in flexible funds. What are the flexible categories at this point of time? They are obviously balanced advantage, multi-asset, flexi cap. These are the flexible categories in the market. And clearly in debt, you have to accept that over a period of time, interest rates will go up. Therefore, again, there categories like floating interest would be better than other categories. That is how we see things at this point of time. The next 3 years are going to be more volatile than the period between 2014 and 17 and 2004 and 7. I do not know why. It is only 2004 and 7 and 2014 and 17 which was easy. So if you look at 2007 to 10, it was tough. 2010 to 13, it was tough. Again, 2017 to 20 was tough. Again, I think 2020 to 23 will be tough. But if you follow the model of asset allocation, have money in flexible funds, and stay invested over the periods where the market is volatile, I think investors should have a good experience. This is how we see things. And as a mutual fund, we always try to have all kinds of products for all kinds of investors. And what we have also done, I must tell you, which I think investors have not noticed, in 2012, we launched the US Blue Chip Fund. At that point of time, the reason for launching was 12 years of no returns in US. And at that point of time, when we launched it, we didn't get adequate traction. In 2018, when again US did badly in October period, we launched something called as Global Advantage Fund of Fund. As Nimish mentioned, Fund of Fund is a very interesting category where we can move money between investing in different funds. In that fund, we have invested in other people's funds as well. We have invested in other AMC's products also. We think, there is a clear case to consider strategies where investors can consider some amount of money invested in other country markets, like these kind of categories. Do they also carry their own risks? They carry all their own risks. And it's very difficult to understand those markets. So that's why we said, let's create one product. And you will find that in that product, we have invested in many countries. Do we know everything about all the markets? The answer is no. But our hope at this point of time is that hopefully we will have slightly better understanding than an Aam Aadmi. And our goal, as you know, is to invest for the Aam Aadmi. And with that goal, we thought that kind of products also we should have. So as a mutual fund manager, as Nimish mentioned, our investment goal is to invest for the Aam Aadmi and to invest in such a way that the Aam Aadmi in the long run benefits. And that has been our goal. And that is why we have always focused on the middle of the road products, like the balanced advantage category. And now in the middle of the road product in equity, like the flexi cap category. And we hope that all of you will look at such categories and invest. And markets will carry its risk. Markets are not where they were in 2014. Markets are in a different orbit thanks to all the work done by the central banks. But I can tell you every day we are focused on it. A number of people in our firm are continuously tracking all these things. Just because we track all these things doesn't mean we get everything right. But I can tell you that is our goal of what we are trying to do. Invest for the Aam Aadmi. Thank you all. And now
thank you.
Take a few questions.
Yeah, thank you, Naren. Thank you, Nimesh, for the beautiful insights on what's happening around. We have a large number of people across the country, and the power of social media, that we have a diverse set of customers who have logged in today and have a lot of questions. I'm going to read out some questions, but before that, is one thing that's common and that's coming across a set of customers. And there are people who are in their 20s asking the same question. People who have retired and have a corpus to invest. And the common trend in this question saying that what are the key things that customers like us should look at while choosing a fund house or product? Sure. We would like to answer that.
See, the way I look at it, the biggest thing is the brand. Which is the brand, and whether the brand is the right brand. See, is when you are looking at a mutual fund, also look at, is it only in this business or are there in many other businesses like ICICI Prudential? We just cannot close our shop and go away tomorrow, right? Because we are not only in mutual funds, we are in many other businesses. We have got a banking business. The group has got a banking business. The group has got an insurance business. So this is one of the business that ICICI runs in the country. So it is not that we'll close off our funds tomorrow, right? And we have to make it work. There is no other country that we operate. So we don't decide. Some 8 to 10 mutual funds would have gone out in the last 10 years out of the country. We cannot even envisage that. So the big brands in the country, I think it's very important because for them it is a long-term business. We are only in our 20s, right? This industry is only 20 years old. We have to work and create a base for the next 100 years. So a responsible brand, the brand has to be responsible. You're managing somebody else's money and you have to be continuously conscious about it. See what these people have been talking. Any fund house, you would have seen me and Naren talking 5 years back. You would have seen me and Naren talking 2 years back. You would have seen me and Naren talking today. Is there consistency in what they are talking? Have they consistently delivered over a period of time? That is very important. Rather than tracking, if you go to some sites and see which is the maximum sales happening, the fund which has done very well in the last 1 year, they tend to be chosen the most. So don't do the selection that way. Go for big brands who have got a responsibility in this country and who are adhering to the responsibility over a period of time. I think that should be the basis of selection of a fund, because if you select the right asset, right, most of your returns will be made over there, right? It is very important to select equity or to select debt the way you want at right point of time. It is rather than using the word asset allocation, I'm saying if you have selected the right asset class at the right time and remain invested it over a period of time, it should be okay, right? You don't know, even if we have got 20 open-ended funds, I don't know which is going to work in the next 1 year. I don't know which is going to work in the next year. If you see the last 10 years, every year a different fund has done very well. But our endeavor is, we have designed it that way that every year a different fund can do well, but over a period of 5 years, all our funds should do well. So it is more important the long-term track record, a very long-term track record, rather than a short-term track record. In fact, sometimes if short-term the performance is not good, it might be an indication to invest in that. And equity, whichever fund house you go with, and if the fund house, all these criteria are taken that it's a responsible brand, then you should remain invested with a long period of time. Do not panic if there is a short-term underperformance, because all the more to invest at that point of time rather than divest at that point of time. If everything else about the fund house is good, there is no need to panic
in a short term because equity investment cannot be consistent, right? Equity investment will be volatile unless you take the asset, the funds like balance advantage fund or a fund of fund like an asset allocation fund, which is trying to mix equity and debt and give some type of consistency, then it is okay. Otherwise, it is better to be with a fund house for a long period of
Yeah, I think, thank you, Nimesh. I think the point you're trying to make is that have a balanced checklist approach and various parameters that guide selection of a fund. One more thing that Nimesh, particularly customers want to ask you. You mentioned about a balance advantage fund being an ICICI innovation which you introduced. But with now balance advantage fund becoming a category and multiple products, how different or is ICICI Prudential Balance Advantage Fund from the other offerings in the market?
See, the way we had always envisaged, we created this category of balance advantage fund. And the way we had always envisaged this product is that customers should buy cheap and customers should sell when it is expensive. And it should happen in a tax-friendly manner because within a mutual fund, it happens in a tax-friendly manner. So we have created this model. The unique thing about ICICI Prudential is that we have created this model almost 10 years back, right? And since 10 years continuously, we are improving that algorithm that based on which we decide on equity and debt. There are no emotions involved when we decide. It is not what Naren feels or what a fund manager in ICICI Prudential Balance Advantage Fund feels. There is no feeling over there. It is only pure data analytics, right? Based on analytics of number of years, the way Sensex and Nifty has worked, we have created those algorithms which decide how much equity. So it's a discipline. How much equity, how much debt, and how much arbitrage is decided by an algorithm, by a model, and not decided by an individual's gut, right? So that is the unique thing about ICICI Prudential. We have created that model and it has worked for a number of years. Look at the performance it has given over the years. Look at the 10-year track record. The fund has got a fantastic 10-year track record where almost the 10-year return would be around 12%, right? That's the kind of return. And by taking minimal risk, you have not invested fully in equity. You have invested only a part of, like today, it is only 40%, 39% invested into equity. Even after investing less in equity, you have generated 12% return over a period of 12 years, over a period of 10 years. So that is the kind of consistency it has been able to give to the investors. So I believe that that model with a track record is extremely important. And there are various models. You should not be comparing. All are not similar. There are some people who have they don't change their asset allocation. It is steadily kept at a very high level. Equities is at a very high level consistently. So in a market like this, which is growing, they will have an advantage because you are in a growing market. If we have kept our equity at 40% and he has kept his equity at 75%, obviously that person's return can be higher in a growing market. But one should see it over a period of 5 years, that how it is, because there will be troughs also when the market falls. How does it do when the market falls? It's very important. Then there is another model, which is a momentum-based model, right? We invest in equity when the markets are down and we divest out of equity when the markets are high. There are models which will keep on increasing equity. It's a momentum-based model. So as the market goes up, they'll keep on increasing equity. So each model is different. I'm not saying one model is superior to other. Our model is going away from risk, right? Go away from risk, go away from equities when the markets are high and come into the equities when markets are low. It's a very simple philosophy and tested over a period of 10 to 12 years. So that's how we are unique in that particular strategy. And based on that, we have created a series of products. We are firm believers of fund also. So this category, the balance advantage category, and then there is the whole dynamic asset allocation category. In fund of funds also, we can create various funds of fund, which will have like asset allocation fund, which will invest in equity, debt, gold. So all those kind of variables. Our specialization in this country is introducing the concept of balance advantage fund in this country. And we are strongly staying by it.
Yeah. Naren, you've always been saying that, we live in a connected world. And, more than anything in the last 1.5, 2 years, the pandemic has shown us that we are always connected. With this, there's a question that comes saying, what's happening around us globally, and how the liquidity is driving the whole markets, etc. So particularly, Naren, any change in the view post US Fed's last meeting?
So we
That's what
live
some
in a
investors-
connected world. We are able to do this work even because we are in a connected world. But one of the sectors which I like, telecom, has not done well. And that is the beauty of stock markets. In the last 15 months, without many trips to office, my entire department has been able to do everything. Many of our funds have also done well, including our technology fund. And that is the beauty of markets. In the last 16 months, why every payment has been made and every NFO has happened, everything has happened is due to connected world, due to telecom. But the worst performing sector is telecom. And that is the beauty of stock markets, that what should happen, how markets deliver returns is very fascinating, actually. And that is the beauty, what sector I thought will deliver, like telecom didn't deliver. And what sector we all thought may take time to deliver in a riskier world like metals delivered. And that is the beauty of how stock markets behave, actually. Coming to your question, I would say that, Fed is very, very important. And the problem is that everyone is focused on the Fed. So last Friday, the job numbers came better than what it is. So all of us thought US yields will go up. Instead, US yields come down. We are reasonably clear, if US yields go up substantially, equity markets will correct across the world. But job numbers come good and US yields go down. So now how will markets go down? So US market went up. So this is the beauty of the whole thing. So that is why even in our talk, we mentioned that, it's not going to be an easy period the next 3 years. Because the Fed has pumped record money. And then, you have a situation where most of the commodity prices have gone up. So how the world is going to behave is not going to be easy to analyze. And everyone is focused on what Fed is doing. And in our world, if everyone thinks about it, how the market reacts to every number is very complicated. So that's why I said the most interesting period in investing is going to be the next 3 years. Unfortunately, it is not going to be easy for us because finally we are responsible for other people's money. And if we get it wrong, it is not going to be easy. So the hope is that we get it right. But every pronouncement of the Fed, we watch as though it is like gospel. And every number that comes out of US, including some inflation number, inflation break-even, what happens to US 2-year, what happens to US 5-year government security, everything we are tracking at this point of time. Because we think it is even more important. See, you have to remember, between 2010 and 2020, we have deflation. In deflation is output price coming down. When output price comes down, earnings comes down. So profits used to come down, therefore always profits were down. Now we have inflation. When inflation comes, earnings will come down. So this year, if you look at the June quarter result, again, June quarter result will be good in many companies. Because if steel price goes up, oil price goes up, zinc price goes up, sugar price goes up, earnings will not come low. So we are in a period where earnings will go up. So we have to worry only about what US will do in interest rates, not worry about earnings. Earnings is not a scope for worry. Between 2010 and 20, earnings was a big worry. So that is why today we have to worry about other things. Whereas in the last 10 years, we at ICICI Prudential were worried about a different set of things. That's how we think.
Yeah, Naren, I think you answered what's happening globally and also touched upon the sectors. But particular question that comes in saying, what are the sectors you believe will do well back home, and what are the sectors that investors should kind of avoid?
Structurally, India is a good market because the business cycle of India has not gone up. All the corporates of India are cash rich. The Indian Reserve Bank is sitting on some 8 lakhs of surplus liquidity, according to my debt team. So what happens is the Indian growth story has not even played out. So what we think is sectors connected like auto, capital goods, all of them should do better over the next 3 to 5 years. Banking, but how to deploy in these sectors is got to be gradual. And that is how we are looking at it over a period of time. And as we look at the new fund offer and in many of our existing schemes, we'll be looking at many of them. As a house, we have been cautious on sectors like, some of the costlier stocks in consumer staples, some of the costlier banks, etc. And in the last 1 year, they have played out on a relative basis. It is not that those stocks have gone down, but those stocks have underperformed substantially without people realizing. Actually, people don't realize that some of those stocks have underperformed 20-30% against the benchmark, but those stocks have not gone down in absolute terms. That is how we see it. And we think that even now, some of those costlier stocks have scope to underperform even from here at this point of time.
Thank you. Nimesh, you spoke about the new offering on the FlexiCap fund. The question that's coming from investors is, can you share how your FlexiCap fund will invest across large, mid, and small cap, especially with markets at an all-time high?
See, I joined this company 14 years back. And since 14 years, we have been tracking, and we have, over a period of time, we have created that algorithm. Every month, there is a tracking that used to happen even 14 years back, that in a particular sector, how are the large caps valued and how are the mid caps valued? And should we say in technology, is there a better risk return available in a large cap, or is a better risk return available in the mid caps in that sector? Right. So we have been continuously tracking that since many years. Over a period of time, we have converted what we were tracking monthly into algorithm. We believe a lot of things with the kind of AI and data analytics that can happen. A lot of the things that we were doing intuitively should be created, or by doing monthly should become regular models. So the way we have created a model in Balance Advantage Fund, we have created a model whereby a relative allocation, how much should be invested in large cap, where is the risk return at the best position today in large cap or mid cap we have in every sector. Based on that, the model that we have created, and that model is extensively used to decide how much will be large caps, how much can be mid caps, and how much can be small caps. If you see the way last 6 months have behaved in the market, where the top 10 stocks have, as Naren just explained, the top 10 stocks have just gone up much lower than the rest of the market, right? The rest of the market has gone much higher than the Nifty also, right? If Nifty has gone up a certain percentage, the small cap and mid caps have gone up almost 46 and 51% up, right? In the last, from October 2020 till today. So looking at that, the way our model suggests that right now the focus would be relatively more on large cap today. If there is a correction in mid cap, this can change again. So it is not that it is permanent, but the model suggests that a heavy allocation will be in the initial stages when we start investing. That is in 10 days from now. The focus will be more on large caps and lesser on mid caps and small caps, because right now risk return fits into large cap better than how it fits into a mid cap or a small cap. So that's where our current thinking is there. But the way the market behaves over the next 10 days, 15 days, this is a dynamic situation. The models can throw different numbers at different points of time.
Yeah, thank you, Nimesh. I think you are trying to tell us that flexibility in investing is also very important in changing market conditions, and investors should benefit from it. So, one more question in interest of time. Naren, this is for you, and from an investment philosophy point of view and how things are evolving in the market. In the last 6 months, value investing has done well, Naren. What is your take on this?
Our view is, we launched Value Discovery in September 2004. And today it's been there for roughly 17 years, just short of 17 years. In that entire 17 years, there have been periods of time when people have cast saying that what is value investing, it won't work. 2006, May to 2008, January, I distinctly remember. And similarly, last year for a period of time, 18 months to 24 months. The reality is, what is value investing is buying cheap relative to intrinsic value. It has to work for the next 10 years, 20 years, 30 years. That doesn't mean there can't be periods of time when it can't work. And there have been periods of time in the last 17 years when it hasn't worked. So I believe that if I take the next 10 years or 20 years, again, it is going to work. And that has been our belief. But on a yearly basis, it is going to work. Answer is no. The belief that we also have is that quality investing also has gone through phases like between 2004 and 2007. It was a big failure. But people don't realize that for 4 full years, it was a failure. And so I believe that the similar questions will also be asked at some point of time on quality investing. And that question people have not asked at this point of time.
Thank you again, Naren. We have a lot of queries and questions coming through, and the way we will do is, our team will respond to each and every specific query at an investor level. You made a note of it. So thank you again, everybody. Nimesh, any parting comments, any thoughts that we should leave with?
Yeah, I would thank the investors for showing confidence on us over a period of time. We bear the responsibility. We are very, very, very conscious. The entire company, the culture of the company is that we are very conscious that we are managing your hard-earned money, and we would not endeavor and do anything which creates huge amount of risk. Any product that we create would be in the interest of the customer. As my Mr. Sandeep Bakshi, the CEO of ICICI Bank, keeps on telling me that Nimesh, ऐसा product दो, ऐसा ही product लाइए जो अपने भाई को invest करवा सके, right? So whenever we launch a product, if we are convinced, if we are investors ourselves, the first people to invest in a fund is me and Naren ourselves. We ourselves first put our money before it comes to the market for any of the NFOs. So I am very much convinced that whatever ICICI Prudential will launch, you should be convinced that our completely belief is in that particular product, and we ourselves are convinced that you should be investing in it, and we will be also investing in this NFO. And please invest in this NFO. As I said, what my boss says, अपने भाई जो अपना भाई को invest करवा सकते हो वही product लाइए. So this is a product where if I will ask my brother also to invest. Thank you.
Thank you once again, Naren and Nimesh, for your thoughts. And most importantly, thank you each and every one of you to join us on this Sunday morning, taking this time. It really means a lot to us. And we look forward to continue our association with you. Thank you again from all of us at ICICI Prudential Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.